Hi guys, so this video is going to be about budgeting. So what is budgeting? Well, I'm sure you've all heard the term before, but budgeting is basically creating a plan to spend and invest your hard-earned money wisely to meet your personal and financial goals. So why is this so important? Well, instead of throwing all your money out the window, it'll ensure that you always have enough money for the things that you need. It can also help prevent overspending and makes it not only easy but convenient to track your money. So, how do you form a budget? Well, the first step would be to figure out how much money you have after taxes. And how you would do this is taking your gross income and subtracting that number by the amount of taxes you have to pay annually. From there, you'll get your net income, so your new income, and I would divide that into 12 because there's 12 months in a year, and personally, I think it's a lot easier to manage a budget when it's just down by the month. The third thing to do would be to write down expenses. So your needs, your wants, your savings, and set spending limits for different categories. Like how much money a month are you going to give to like vacation or shopping? Or how much money are you going to set aside to pay off your debt? Or how much a month do your utilities cost? And then the fifth thing would just be to review your budget regularly because things change. You might get a raise, you might switch jobs, and the amount of money you earn overall is the basis of your entire budget. So, something really easy that you can remember when sorting out your budget is the 50-30-20 rule. And this is a budgeting technique that separates your pay into three different categories. So, if this is my monthly income, half of it should be dedicated for needs, and then 30% of it should be for wants, and 20% should be for savings and debt. So that can include paying for emergency funds or saving for retirement and paying off loans. So, how do you differentiate needs versus wants? Well, needs are something that is necessary to live, such as rent or mortgages, groceries, or utilities. And wants are something unessential to life, but are desired and can increase a person's quality of life, such as traveling, shopping, or streaming services. Because Netflix isn't completely essential to my being, but I do enjoy watching TV that isn't cable. So on this page, I have a fake budget that I created for an imaginary person. So on the top, I have the 12 months, and then on the right, the most right, I have annual. So this is just how much we're spending. So their gross income is about $100,000, but the amount of taxes they have to pay is $33,000. So how do we get this number of $33,000? Well, you have to look at your tax bracket. So this person is single and living in California, and because they make $100,000 a year, their state tax rate is about 23%, but their federal tax percentage is 10%. So you have to add the 23% and the 10%, and you'll get approximately 33%. And with this percentage, you would multiply it by your gross income, which gives you 33,000. So if you subtract your taxes from your gross income, you get about $67,000. So if you divide $67,000 by 12, you roughly spend about $5,500 a month. So as you can see on the left-hand side, I've kind of separated things into categories like needs, wants, savings and debt, and emergency. So needs would be something like electricity, water, gas, car payment, mortgage, rent, healthcare, phone bills, internet, cable, and food. So in each month, the numbers that are not bolded, that is how much money I've set aside for this person to spend per month. And then at the bottom of these categories, like right over here, is a bolded number. And that is all these unbolded numbers added up. So the same thing goes for the wants and the savings debt. So if the total amount of wants is 1,000 and the total amount of savings you're paying off and debt you're paying off per month is 11,000, if you add these bolded up numbers together, you get a number that is slightly less than this. So if you subtract that number from your total expenses per month, then you have leftover money, which can be used as emergency money. And you're not always going to have emergencies every single month. So this money can add up, and if you end up having a super big emergency in your house, like your bathroom start flooding or something, then you can use that money to pay it off and it won't make a huge dent in your bank account. So I would always recommend making a budget on something like Excel or Google Sheets, because if you change the numbers around, then the total number will change too, and you can see the difference. So in January, the mortgage slash rent, depending on if you live in an apartment or house, was $1,800. But in February, it was lowered to $1,500. So this person has to pay $300 less per month. So over here, the bolded number is less because they're paying less. But in emergency, $300 gets added here because they didn't have to spend it on their mortgage slash rent. In March, this person has overspent their budget on restaurants right over here. Instead of spending $500, they spent $800, which is kind of why they have a negative value down here. And you never want to see a negative value on your budget. So adjusting your budget. This means basically modifying or fine-tuning the money you have separated into various budgeting categories. And depending on your life situation, you can do so weekly, monthly, or annually. Another thing to do when adjusting your budget would just be to compare your actual spending to your proposed spending, because sometimes you are not spending as much as you plan to, or sometimes you're overspending. So you need to, reel back on how much money you're putting to each category. And the last thing would be just to assess new income or expenses you have to pay for. Because if let's say you get a dog, then you're gonna have to pay for their food and, their hospital checkups, and that's a new expense. And that can also fix budget leaks if you're spending money on your new pet, but it's not in your budget and you're wondering where all the money is going. That is a leak. So we're just going to end off on good spending habits. So some good spending habits would be spending less than you earn, setting aside money for savings as soon as you are paid, because as humans, we are forgetful, and if we spend all our money at once, we might not remember to put it where it's super important. Comparing costs, because one store might have a shirt for $300 and the other store might have the same shirt for $100, and you don't want to be paying $200 more for a shirt that you could get at another store. And the last thing would just be to think twice before you buy something, because sometimes what you really want is not necessary and it's just gonna become something useless in your life, and you don't want that. And the last thing, bad spending habits. Shopping for status, shopping for entertainment, paying too much for certain items, paying for memberships you don't use, or impulse purchases. I really need to stress the fourth point because, as I said before, we are extremely forgetful. And if you have a New Year's resolution in January about going to the gym, so you buy a membership for the gym, but then you don't end up going like February, March, April, May, June, July, you don't go any other month besides January, the month you paid for it, then you have to spend money on 11 months when it's so unnecessary. And impulse purchases, which really just goes back to thinking twice before buying something. And that is it. Thank you so much for listening, and stay tuned for the next video.